Hi everyone, David Maley here, and today we're going to do something really cool. We're going to look at and forecast the stock price for Tesla. We want to see where is it going to go by the end of the year. In 60 days from now, which would be the end of the year, where is this stock going to go? Is it going to go up, down? Is it going to be a good buy, a bad buy? What is it? We're going to do this using data science. So we're going to use arima models. We're going to use 4 different ones and compare them, and we're going to get right into it. We're going to end up with graphs just like this one here, where you'll see, what's it going to be. Now, I'm not telling you what this one's going to be yet, if that one's correct or not. So let's just move this over this way. Let me take you to the beginning of this so we can get, this is all done in R Studio and R, okay, the R programming language. And this can be a quick go through, so it's not going to be something where you just want to learn how to code. I'll show you the code, but we're going to go through it really fast, okay? It's primarily to get you to an interesting way to look at data science and how data science would look at forecasting a stock price like Tesla. So we use these packages over here, QuantMod, T-Series, Time Series, Forecast, XTS. Then what we do is we use get symbols. Get symbols, what that does is it goes and gets all the values for a stock price from Yahoo Finance. And this goes back years. So in this case, we're pulling from 2005, June 1st, to 2020, which is now of 10/27, which is just a few days ago. So we're going to pull that. Actually, I don't have time right now to go and redo it. It takes a while to pull that, but we'll pull that with this code. Then you go and if you hit this class of Tesla, right? So that pulls that and automatically puts it under the ticker symbol. Okay, if it was ExxonMobil, it'll be XOM. Then you put the class of it and it'll tell you it's XTS Zoo. So what that means is it's got multiple factors to it, right? So we want the fourth one. The fourth one is the closing price. You got the open, the high, the low. We want the closing price for each day to use. So that's what we're doing right here. So what we do is we take the fourth, which is comma 4 of Tesla. So that's the fourth item or the fourth value. We're going to put that in something called Tesla close prices. And then what we're going to do is we're going to plot that. And we use this par mfro C1, 1 to have one graph like you saw right here. So if I do that, we end up with this. We bring this back here a little bit so you can see it better. And you can see there's been a massive meteoric rise in the price lately from January of this year till now of Tesla. Just really shot up. So is that maintainable? Is it going to keep doing that? That's what we're going to look at right here. So let's do this. Let's close that down a little bit. And next what I want to do is I want to look at the ACF and PACF. And what these values are going to do is they're going to give me a better look at this, like the P and the Q values for a custom arima model. So let's take a look at this. If I take this C1, 2, now I want 2 graphs, right? And I'm going to do it both for the PACF and ACF, right? So we've got the ACF for a different series and the PACF for a different series. We do that. We've got them both here. Let's pull this back, take a quick look at it. And you can see here from this, we do have a lag at 1. Somewhere right around 1, okay? So if we go with that, and then we're next going to, so remember that one, and then we go over here and we get the ADF test, right? Print ADF test. Let's see what that does. That puts over here, there's no graph for this one. It's an augmented Dickey-Fuller test. It gives me my p-value of 0.99 and the lag order of 13, which is important. We'll use that in just a minute. Next, we want to do the auto arima, which is this right here. This code to the Tesla close price, which we got above, seasonal equals false, auto.arima. We do that, and from that we have an arima right here. It gives us of 320, right? P, D, Q. That's 3 is the P, 2 is the differencing, and 0 is the Q value. So if we go from that, now we want to bring in, so we've already got that. We want to put in the auto arima, right? We want to have 4 different models we want to compare. So the auto arima is going to go in fit A right here, and we're just going to call it 320 model residuals. So we just do that, and we get this. I'm not going to run each one of these because these ones with the 2 differencing and these custom arimas can take a while to load up all the numbers. But what we're going to do is, so you've already got that one there. Now you can see that there's some lags over here, so it's not perfect. See all those outside of the upper and lower bounds on both graphs? So what we want to do is we're going to have a fit B and a fit C. Fit B is going to be 3, 2, 13. Remember, our order from above was 13, right? The lag order, it told us. So from the test that we did, so we want to put that in there. 32,13. And then when we look at the data, we see that there is a lag, or you will see a lag at around 37. So I'm going to correct it and also put a 3137. See how I do that? So I'll have those two there. And then the fourth ARIMA model is just a default. I like to throw this one in. This is the 1,1,1. And the reason why I use that is almost every default business intelligence tool that gives you forecasting will use a 1,1,1 model by default. You can, in some of them, you can go and customize and use a 3,2,1 or 3, whatever, or 3,2,0 or something like that. But this is the standard de facto. So let's use that. And then what we do next is we take those fits, A, B, C, and D, and we're going to put them all in one graph by using this par mfro equals C2, 2. So we're dividing it up into 4 boxes. So you'll be able to see 4 graphs over here. And so let's run that. And then we'll also run these guys. So if we run that, all of them, it gives us all 4 of them for 60 days. See, term is 60, and I put that in there as a variable. So I don't have to go and type in the term for each one of these. If I want to change it, I just change it one time over here. Makes it much more easier to do. So let's bring this over. And right now you're looking at these 4 graphs for 60 days. You've got this one goes down a little bit. This one goes up tremendously. This one is kind of a little bit of variance at the beginning and then straight across, and same with this one, straight across. So after looking at those, we can also go and look more into forecast 3 or 4 or whatever. If I want to go and show 1, I do this with the par mfro 1,1 instead of 4. And we do this, and I end up with that. I can bring that back and look at that one, and you can see where I was talking about a little bit of variance at the beginning, and then it kind of goes straight. So it's saying, if I go by that one, the 3,137, it's saying that, there's going to be some variance. It's going to be some ups and some downs, but generally speaking, from where it is right now, it's going to basically go sideways. That's what that one's saying. So now let's see which one is more accurate, right? So if we do accuracy of these, forecast 1, 2, 3, and 4, we do that. We end up with this right here. And the main one you will look at here is called the MAPE. So if we move this over this way a little bit more so we can see it better, run it again. See the MAPEs? So what you want to do is you want to look at it 100 minus that number. It gives you the percentage of the MAPE, which is the mean absolute percentage error. And it's a leading error indicator. So what that tells you here is how accurate you are, the opposite of that. So in this case, the best score would be we want the lowest of these values right here, which is clearly this one right here. And that is FCAST 4, which is actually the 1,1,1. In this case, that's more accurate. And it's 97.61% if we were to run that. And what we did here, you just take 100 minus that. And you can also do it for a term of 30 days, like this, if you wanted to. You could do it for a term of 180 days. Let's say I want to go deep into next year. I want to go, instead of going in November, I want to go all the way into April of 2021. Where is this going to be then? Well, you can't see it much from here, but if I bring this back, now you can see here from this, this one's kind of hard to tell because the graph is so different here. The height of the graph is much lower here. So this could actually have a very low range, and that's kind of misleading, that graph there. So I would not use that one. This one it's going pretty high. Again, this is not quite as high as this one. This right here, this of the regular numbers. So these are going to be more accurate. These two down here, that's going to have much more variance in it. This one says it goes sideways. This one says it goes sideways. So out of these, I'm going to say that this thing goes sideways, which is probably right. So for the next 6 months, you're looking at some sideways action there. So let's take a look at this. If we look at Fit D as our most accurate one, we can get the forecast of that right from here. And so we can do this. And basically, if you look at the forecast for that period of time, it starts off at $420.24, basically, ends up at $420.25. It basically went sideways and you made a penny. So basically, in looking at that, if you look at 4 ARIMA models with some pretty high accuracy there, and it's telling you that Tesla, it's going to have some variance, but it's basically going to go sideways for the next 6 months. Is it a great investment? Depends. You have to look at the payout what you're putting in it. Is it better than something else you would do? And what is the dividend on that stock, or is there a dividend? Those are things. I'm not trying to tell you whether there is or isn't. You have to look at these things. This is also not meant to be financial advice, so please don't use it as that. Go get yourself a financial advisor. Go look at Yahoo Finance. Go look up these stocks and look at it for yourself. But if you look at Yahoo Finance, this correlates exactly with what they're saying. They said on there for a short term and a long term, it's kind of got a bear pattern. So we're about right. The medium term might have some possible growth, but overall we're looking at some sideways action there. So this shows you how we would look at this for forecasting this stock of Tesla in R and with data science. I hope you found this interesting and informational. I do run through all this code. If you want to see all the code and more explanation, I have other great videos on my channel that you can use to do that. Thanks again. I hope you found this interesting and helpful. Please take a moment to subscribe, like, and share, and have a great day. Thanks.